This is tax efficiency through charitable giving with Bruce Kendrick. The floor is yours.
All right, so yeah, to kick things off, not a CPA, but I know a lot, enough to be dangerous, we'll put it that way. And so, like I said, if it comes down to a very complex question, I've got some really smart folks I work with, and we can just kind of get answers on the fly from actual CPAs. I work with capital markets, stocks, bonds. I gave a talk yesterday specifically towards kind of what we're doing in the endowment a little bit, but just a Q&A session. And there's no rules on what we're going to do today. I just want to make sure by the time we get out of here, you guys have your questions answered. And if you think of something later after the fact, that's my contact information. My cell phone's on there. You guys call me, email me, whatever is the easiest way for you guys to interact with me. You guys are all my clients. The church is obviously has been my client since 2019. So to kind of kick things off, obviously I run the endowment, and in that account, you're able to provide charitable distributions in a variety of manners to benefit the church, which I think is important to everyone sitting at this table, including myself. So, I'm going to start really basic, and feel free to interrupt, ask questions, but we've got two types of accounts that we're thinking about. We have qualified and we have taxable. So qualified accounts are going to be retirement accounts, and there's a variety of them. There's Roth IRAs, there's rollover IRAs, there's 401ks, there's SEP IRAs. It runs the gamut. And kind of starting with qualified accounts, obviously the government, they like to think of ways to get their hands on your tax dollars. And so they came up with the required minimum distribution. And so that's a term I'll use, RMD. And so basically what happened was all these people were putting money into these retirement accounts. And the benefit of that is it grows tax-free. So you can buy and sell stocks within a qualified account. There are no capital gains liability. The only time that there is a tax event created when you're dealing with IRAs or qualified accounts is when money leaves that account. That means that if it's your account, money comes out, you have to pay your taxes. The government likes that. They invented the required minimum distribution to force you to take that money out. And I believe the age is a moving target, but right now it's 73. And obviously that's, money comes out, government takes their share. And a lot of people will use those required minimum distributions to subsidize their budget in retirement. A lot of people will use it, but there are some people that don't need to use their RMD, and they would prefer maybe the plans on their IRAs, because they're not utilizing them, is to pass that along to the next generation in an inherited capacity. So they obviously want to benefit the next generation, and everybody has different goals. Everybody's tax situations are different, but they take that money out, or they leave the money in the accounts and then pass it on. Required minimum distributions obviously are something that can create big tax events, especially if you've retired before 73 and all of a sudden you're not getting your paychecks anymore. You're living off whatever money you've saved, and then lo and behold, when you turn 73, all of a sudden your tax picture changes, because you're getting this huge lump of money depending on how big your IRA accounts are, and you're having to pay taxes. That's part of your adjusted gross income, or AGI.
I have one question.
Certainly.
Some states tax this and some states do not. Is that correct?
Federally, you will be taxed on anything that comes out of an IRA. Now, states are obviously more specific, where some states do not have income tax, some states do.
Okay.
That's where it gets really convoluted and in the weeds, but specifically with Colorado, there is a state tax.
Okay.
If you live in Texas, obviously that's a different scenario. And I am originally from Texas. And now I live in Colorado and I pay state tax on
And
everything.
Texas does not.
No, it's not.
Yeah.
But federal taxes, the federal government's going to get their hands in that cookie jar. So there's no way around it. And everybody's situation is different, like I said. So if you have some specific questions, I'm going to try to be broad. But when we talk about required minimum distributions, obviously if you're going along in retirement and then you have this event that you're forced into, that changes your tax picture a little bit, but there are ways to mitigate that. And a couple of ways to do that is through Roth conversion. So if you have a Roth IRA, which is different than a traditional IRA, a SEP IRA, they all have these unique characteristics, but Roth IRAs are great because the money that goes into a Roth can be invested. And then as that money grows, there's no capital gains tax. If you decide to use that money, you're not being hit with your adjusted gross income like you would if with an RMD. So looking at Roth specifically, there's a lot of guardrails around Roth. So if I'm a younger person and I'm getting paid, whatever job I have, they set limits. So if you make a certain amount of money, you can't even contribute to a Roth. Once again, the government's trying to, dot their I's and cross their T's and make sure they get a hold of that tax money. So, if you want to contribute to a Roth, sometimes you're priced out of it because you make too much money with whatever career you have. But once you get into retirement, you're not going to contribute to a Roth potentially because you have to have earned income to do so. And if you're retired, you're getting Social Security, you might have a pension or all these ways that income comes in the house, but it's not income derived from a job. So it's not earned income. That's kind of the key word there. So when we look at RMDs and how they're calculated, the IRS is using an actuarial table in this what we'll call equation. And it's based on, what your age is and then expected life. So males and females, according to the IRS, have different lifespans. But when we look at RMDs, they take the amount of your IRA that you have to take the RMD from on December 31st of that year that you start, and each year subsequently, they'll look at the amount, and that factors into the amount that you have to take out. So larger IRAs, you're taking a bigger tax hit. You have to take out more money. So how do you mitigate that? Well, you reduce the amount of money in your IRA. And there are different ways to do that. One of the ways is obviously through Roth conversion. So if I can make that balance lower when I have to start taking RMDs, then I'm not going to take such a big hit. I don't have to take as much money out of my IRA. And everybody's circumstances are different. Some people want more money out of their IRA because maybe their Social Security can't subsidize their living expenses, whatever it is. And each one of you are different. So like I said, I'm going to be broad. And if you have something specific to your tax return, anything like that, just you can jump in and ask questions. But yes, sir.
Are you going to get into QCDs?
Absolutely.
Okay.
I'm starting with Roth conversion. Once again, it's not like you're moving the money or converting it to Roth and you're not having to pay the taxes. You are. But some people who are nearing retirement or they're still working, they can afford to pay a few extra taxes to get the benefits down the road when they have to start taking these RMDs. And the next piece of this, QCDs, and my industry is full of all these great little, 3-letter, definitions, things like that.
Acronyms.
Yes, lots of those. But a QCD is a qualified charitable distribution. And this is where people who are philanthropically minded can, number one, help themselves when they file their taxes, but number two, they can benefit organizations that are important to them. The church being a prime example, where something you care about, you can help your tax situation out by obviously donating to the church. And through the qualified charitable distribution, that's how it's done. So kind of going back to what I was talking about, when you have to take out a large sum of money and pay income tax on it, that's not very fun, right? Whatever tax bracket you're in, everybody's different, but it's never fun to have to pay those taxes. So if you don't need that money, if you're not living off your basically your RMD, I guess I can say that now, we all know what that is, but if you're not living off that, and you would just be very happy leaving that account intact and passing it on to kids or grandkids, whatever it is, this is a way to help out, because you can take that RMD and you can donate the whole thing to an organization through a qualified charitable distribution. So I'll kind of give you an example. From a qualified account, we're still talking about IRA. You turn 73 and you find out that your tax liability is going to be an RMD of around $60,000, and you don't need it. Sorry about that. You don't need to necessarily have your RMD to subsidize your budget. All it is a tax burden for you. You can go ahead and just take that directly from your IRA and move it over to the charity of your choice. And you are not paying 1 cent in income tax on that money. It is donated to charity. And so, number one, you didn't need the money in the first place. So it alleviates some of the tax burden of having that RMD come out of the account and go into your bank account. So that is, the first thing we'll talk about, QCDs. And all you have to do is get in touch with whoever is your plan sponsor or the custodian of your assets. I work with Charles Schwab. They're the custodian of the church's assets as well. We just manage the assets, but I would work with a client. I'll give you an example. I have a client, 2 clients in North Carolina, don't have any kids. They don't need their RMDs. Their plan is, they have pension assets, Social Security assets coming in, and they are really into what we'll call, dogs and cats, and so they donate to their Humane Society in North Carolina, and they take their RMD and just move it over. They call me, I get in touch with Schwab, they fill out a form, we put the amount, and away it goes. They're not burdened. Their adjusted gross income isn't affected by the money. It goes straight from the IRA to the charity of their choice. There are some individuals in the church who have done that in different ways. They have taken it straight from their IRA and just moved that stock or the value of their RMD over to the church's endowment, wipe their hands of it. They basically saved a lot on taxes because they didn't have to, realize the gains by moving that into their account. So that's a qualified charitable distribution, which comes out of an IRA or a qualified account. Yes.
Okay, you don't have to take your total RMD, right? Can you take a portion of it?
Yes.
Absolutely. So they took their whole, they do not want it. They don't want the tax burden. They moved the whole thing over. But you could take $5,000. You could take $1.
Whatever you want.
Correct.
Yeah.
And depending on your tax situation, and obviously if you file your taxes through a CPA, he can be very helpful when it comes. All you have to do is say QCD. His ears will perk up and he'll help you kind of figure out what makes the most sense for your particular tax return. We're all different. But like I said, I'm going to keep it high level. And this is specifically dealing with a qualified charitable distribution is from an IRA, so a qualified account. And what's the rule of thumb for IRAs? Anytime money leaves that account, it is now a tax event, and you will be 1099 for it, and you will owe money. Well, it doesn't even come to you. It goes straight to the charity. The IRS is really okay with that. I'm sure they'd like to have that money, but unfortunately. Using qualified charitable distributions is one way to mitigate your RMD and what that could mean in your lives. It's a tax event. It could be bad, it could be good if you need that money and subsidize your budget. So each person you have to look at individually. And that's what I'm here for. I'm here to kind of sort through it. Obviously, we have some CPAs on our planning team. where I can sort of work with them and kind of help determine what the best route is. Does it make sense to move the whole thing over? Does it make sense to move a quarter of it over? There are also ways to donate to your church and save yourself tax dollars from a taxable perspective. So if we think about taxable, in my world, that's a brokerage account. So if I have an IRA I'll use Charles Schwab as an example because I do. I have an IRA there, but I have a brokerage account as well. And that's just for general investing. And attached to that account is a debit card and a checkbook. So I have securities in the account, and if I need to spend money, I sometimes will sell stocks that have appreciated or depreciated, whichever one is more tax advantage, but I'll sell that, create a cash pool, and I can spend that money. So it's a bank account that has investments attached to it, but it's a taxable brokerage account. So qualified, taxable. So on the taxable side, a lot of times I'll give you some examples, and these are real world examples from my client relationships, but I have a client who used to work for Facebook. He was an engineer at Facebook, and he, as part of his compensation, obviously was paid a salary, but he was given a lot of stock options. And so what happened in working for Facebook for probably 8 years, he has amassed this large quantity of Facebook or Meta, whatever you want to call it, stock. And it's obviously appreciated because what was everybody doing in 2023? They were throwing money at any company that was associated with artificial intelligence or AI. And Facebook was obviously one of the beneficiaries, along with 6 other companies. But he's very happy, right? He worked for Facebook. He got this lovely parting gift from Facebook, all of this stock that appreciated. So now it's sitting in a taxable account. So if he sells any of that highly appreciated Facebook stock, he's looking at a nice big capital gains bill, depending on how much he sells. Capital gains is, and I'll give you some rules, but like I said, there are so many rules to what I'm talking about that if you have a question, you please ask me. But basically, if you hold a stock for a year, and then you sell it after that, and it is appreciated, you have to pay 15% of the gain. So whatever you got the stock at is called your cost basis. And if the stock grows, you've got a tax burden on the growth. You have to pay the government 15%. If you sell an appreciated stock before you've held it for a year, you have to pay whatever your tax bracket is. You have to pay that rather than the 15% for long-term capital gains. So we have long-term capital gains. You hold the stock for a year. Short-term is going to be anything less than a year. So if I'm a day trader and I'm trading in a taxable account, I'm going to probably not have a lot of long-term capital gains. And if I have a large or modified adjusted gross income that I'm accountable for, that any of the growth on what I sell in a taxable account is going to be, I have to pay my tax bracket. So sometimes holding it for a year helps you a little bit if you're in one of the higher tax brackets. So he's got Facebook. He's looking at, if he sells any of it, he's looking at paying a large chunk of capital gains. But he doesn't really need to sell it. And he's looking to kind of take some of the risk out of his portfolio. Because when you have all your eggs in the Meta basket, something happens to that company, and it happens every day. Zuckerberg could come out and say something maybe negative, and that's in the headlines, and then you see the stock of these hyperscaler growth companies. You'll see them move up and down. And I don't know how many of you invest on a regular basis or watch CNBC or anything, but a lot of these more aggressive or higher beta growth companies, they could be up or down 20% in one day. So he's looking at his account, and if Facebook does something bad, he's looking at, most of his account is just destroyed until the stock recovers. Who knows if these stocks recover? Sometimes they do, sometimes they don't. Facebook has been very lucky. So he sort of devised a plan where he wants to use taxable assets to donate to a charity of his choosing. And he is in Northern California, and he's very ingrained in his church community. So he wants to basically donate to his church. And so he's reducing the concentration in his account through his Facebook position. And he's able to move the stock over to the church's endowment, kind of like what I do with Community Presbyterian. And when he moves that stock over, he gets to deduct that from his tax return. So it doesn't work the same way as qualified accounts, but you could still take stock if you have a concentrated position in your portfolio and move that over or donate it to charity. And you can get the benefits of that when you file your tax returns, because it's a deduction that you can basically, and once again, a CPA knows all about this. And if you kind of told him what your plans were, he could make that happen for you. But so you can donate to an organization, to a, whatever they call them, 502, 503B.
502(3)(c).
There we go.
Something like that.
So you can donate, and that's the key. It has to be one of those, right? You can't just donate it to your kids or, whatever. So,
But you're still taxed on that at your, to count it as a deduction, then you go into the formula of how much you can deduct and
correct.
with your income.
That is a great observation. And I'll give you some numbers here, but basically you can only deduct 30% of your adjusted gross income. So 30% of all the income that you file for in your tax return, that is the most. So he went to a CPA and we looked at the account and we said, what's 30% of this position? And that's the number that we moved over to the church. So and this is where the IRS likes to confuse us, right? They make it sound really good, and then all of a sudden you find out, well, wait a second, I'm only good for 30% of that, but I donated 50% of my position, or 50% of my modified adjusted gross income. So, like I said, if you want to, participate in any sort of charitable giving, the rules are always changing. So I would always say consult with me. I can go to our CPAs or consult with your CPA, because once again, they want you confused because you think you're doing yourself a big service, and you find out on the other end of it, well, maybe it's not so good. So just kind of just pausing right there for a little bit. Let's if you guys have any questions, we're talking whether it's on the taxable side, whether it's on the what we'll call the IRA or the qualified side.
Okay, yes, I do. Okay, if you take the RMD out of your retirement fund,
Mhm.
and say you don't use all of it, but
Mhm.
you take a percentage of it, will the person who administers your IRA, will they then count that as part of your RMD? Do they subtract it out of your whatever, and then we get our little statement in January every year that tells us what we have to do.
Mhm.
But if we have we have it set up now that we give so much per quarter to the church here. So they take that into consideration when they figure out our RMD.
So they're going to calculate your RMD, and then you'll know what that calculation is generally. And I'm speaking in terms of Schwab as a custodian. Every Schwab client, when they go to their IRA, can look, even if they're not old enough to take their RMD, it'll tell them the year that they have to take it. And then as you get closer to the year, obviously you have to have December 31st happen before you can actually calculate,
Right.
but they will tell you the amount. So if I'm turning 73 in October of this year, I know that I'm going to be having to obviously pay an RMD, and they would give me a total there. So you have to take care of your qualified charitable distribution on the front end of that. You can't just take the whole thing out because you're 1099'd on that. The IRS says, okay, this client, this person took X amount of dollars from the IRA. They don't care. if you come back and tell them, well, wait a second, I donated it to here or there, you don't get the same benefit because you have to itemize that on your tax return. Whereas a QCD, you take care of it on the front end. You let them know what your intention is. You fill out whatever form, and different custodians have different methods to it. But you signify an amount on that form. They pull that out and it goes away. And the only thing, if it's the whole thing, then you're 1099 on that and it shows that it all went to charity. If you took half of it or $15,000 or just whatever the number is, that's going to be disqualified. So when your 1099 is going to show that amount as being not taxable, but whatever amount you did accept into your bank account, that's going to be what you're taxed on.
Okay, so
You have to do it on the front end.
you have to do it beforehand.
Correct.
Even though, say in the middle of the year, we say, oh, we want to give $500 to something or 5,000, whatever it is.
Mhm.
And you do that then, you can't really do it in the middle of the year. You'd have to do it in the first of the year to. No.
That's a great question. And once again, I'm here to try to, sift through the fog of taxes. But so on the year that you turn RMD age, you've got your amount, but you have the entire year to take it out.
Right.
So the only thing you have to do is decide between January 1st and December 31st when you just have to get it out in that span of time. So you can, if you don't know how much you want to give, if you don't know what your situation looks like, if you need to subsidize any of your budget with your RMD, you'd probably wait on that until you did know that, but you have a whole year to figure it out.
Okay.
I was just looking up QCD and it means heavy quark effective theory.
That could be applicable.
But my question was,
Yes, sir.
I think the current limit is $100,000. Does it go up next year? Or do you know?
I don't know, but let me see. I took some notes here.
The limit on what?
Qualified charitable
Oh,
distribution.
as an individual, how
Mhm.
much you can do? Okay.
Here, I'll tell you right now. This AI is good for something, right, guys? It hadn't killed us yet, so I've seen the Terminator.
I call it artificial stupidity.
They're usually right. Yeah, it's usually correct.
There was an interesting article today where they asked 5 of the leading AI bots, whatever you want to call the same question. them, and see what answers they gave. And it was remarkably
Same.
consistent.
Yeah. They didn't call it intelligence they called it intelligence for a reason.
Programmers are even using AI now to code. In other words, to write programs. And they say that it's probably
They've
right
been using it for
80% of the
years.
time. It's amazing.
So $108,000 per individual. So if you file jointly as a married couple, $216,000. But that's the tricky thing because they're going to move it. We usually kind of get an idea of what the IRS is trying to do, and that's what CPAs do. They sit in classes and do continuing education, but we kind of get an idea of what they plan to do, but it doesn't always come to fruition. So it's kind of a tough one. You don't really know until it becomes part of the tax code, and there's they give you enough to chew on, enough to speculate on, but they don't give you enough to actually formulate a solid plan on. You have to, make it a little more convoluted with plan A, plan B, but right now it's $108,000. And that's something I just don't have the time to keep up with because I'm talking to people every day, nice folks like yourself, talking about allocating their portfolios and strategies and planning. And I leave this to the CPAs. That's their job, and that's why they're compensated, accordingly. But But yes, 108,000 is the limit on QCD. So if you have an RMD that is greater than that, you know you're gonna have to pay some taxes on whatever that is above the maximum.
I believe, and not to interrupt, but.
You are not, that's what we're
I don't
doing.
know if it's Schwab, I don't know if Schwab does this or not, but it'd be easy to find out. I think that they will give you a checkbook that is strictly for QCD. And that it's tied to your IRA, and you just write a check directly, and they just deduct it from whatever your RMD, and then if you have it set up with them correctly, at the balance at the end of the year, they will true it up and
Take that out.
and take
That's
whatever the
assuming you
balance
don't take,
is.
say, a
and
monthly
put that into
amount
your-
or whatever, you're not taking it out as you go along. Or can they balance it out at the end?
They can true it up, so that you don't face a tax penalty because you didn't take enough, didn't take your full
Yeah.
RMD within the time frame.
Bruce, what happens if at the end of the year, have an educated guess about what your adjusted gross income is?
Mhm.
And you wanna give away 30%, but then you guessed wrong, and so you gave too much for that year, then can that carry forward into the next year? How's that work?
It cannot. It cannot.
Can it be replaced? It cannot be replaced either?
No.
In other words,
So then you
took
get
down this
taxed
tax.
on whatever your excess.
It's just the excess deductions just not allowed.
Right.
Yeah.
It just becomes taxable income,
Taxable.
whatever it is. But that's interesting because, you've got from December 30, you basically have from January 1 to December 31st to get your R&D out. A lot of people don't do their taxes. They don't have to do their taxes until April. So that's where obviously having a tax professional, having an idea, they can look at where you were last year, and if they'll ask you what's changed, if you've had any sources of income additionally since the last filing, whatever it is, obviously they can kind of, nothing's set in stone. It's always a projection, but they can kind of give you a very, what we'll call, close idea of what makes the most sense. And we also offer at Frontier, we do something called Holistiplan, where we'll take your last couple of tax returns and kind of do the same thing. We'll look at your investments, we'll look at all the sources of income, basically plug in a lot of data from your tax return and kind of get a good idea on what makes the most sense for QCD, for Roth conversion. As long as you kind of have an idea of what that modified adjusted gross income is. But some people, it's hard to track, right? Some people aren't sitting there saving receipts from their meals and things like that, like it was in the old days. A lot of people just kind of kick it off to a CPA and say it's worth it to pay the money to have this person file in my stead. So, each person's situation varies. But, like I said, if you're working with a financial advisor, a lot of times they offer more than just portfolio management, and they can, like I said, we have this Holistiplan thing that we run for clients exactly for those types of situations to kind of look at because maybe a lot of people don't know what their adjusted gross income is. Sometimes things happen all the time. People inherit assets, whatever it's obviously a lot of moving parts in a tax return every year. But if you have kind of a standard number when you file, it's easy to kind of project into the future for the next year. And so we kind of do this process with our clients where if they're using a Holistiplan, we'll update it every year. They'll send me their tax return, we plug it in, and we can kind of look at, a lot of things that affect people who are retired. Like, if we talk about Medicare and income, sometimes you have to pay more for Medicare or you're penalized because you have too much income. And so there's a lot of moving parts in what we're doing. So we're actually looking at ways we can help that out. So if we find a person who might be up against the next tax bracket, and if they're in a dividend portfolio that's paying a lot of cash flows, all those the dividend yield or interest from bonds affects the income that you're earning. Even though it's not earned, it's coming from your investments. And sometimes you can't really, you don't know because dividends get caught all the time. Bonds are a little easier. Bonds are an exact science. We know how much they're going to pay, when they're going to pay with the coupon or the interest rate on the bond. But with equity, company has a great earnings quarter, they might raise their dividend if it's a dividend company. So we try to use predictive software to figure out what each person's tax liability is from dividend yield and interest. That kind of goes in the holistic plan as well. But like I said, if you're ever, in a situation where you're getting close, or you wanna have more exact insight into what your tax liability will be, that's where tax professionals are they're invaluable. They are extremely important. So, like I said, we've got qualified, we've got taxable, and there are all these rules around how you give to charities on both sides of the house. And hopefully, if you're charitably minded, you've got some assistance. And if you don't, obviously use me as a resource. Because like I said, I work with individuals who spend their days staring at the big, beautiful bill and trying to figure out what that's going to mean for everybody. Because you just don't know. And every administration has changes they want to make to the tax code. So it's this moving target. Like I said, the IRS isn't complaining one bit. But as far as, I have helped people give to this church, this very church, on both the taxable side and the retirement side. And like I said, different people have different interests. So, you might want to give to 10 different organizations, even better. Then you can kind of sit there and look at what your RMD is for the year and say, okay, well, we need at least $20,000 because we're going to take a cruise this year, or we're buying a boat, whatever it is. And then we know we need that. So I can just divvy up the rest to church, to, the local SPCA, which, like I said, my clients in North Carolina did, or, I've got the client in California, the Facebook guy. He just wanted to get rid of the concentration in his account. So he went ahead and used that to help him now by deducting it and giving it to his church. So it kind of, everything's situational. So I would ask any of you to call me if you have a particular situation that's unique and you'd like for us to sort of brainstorm around it on how you can give to the charity of your choice. But like I said, this is for you guys. Any questions you might have?
I hear the question, what's the advantage of making a direct RMD to a charitable? And can you explain how that can keep you out of the next tax bracket?
I mean, yeah, that's a great question, and it's a very common question. But kind of looking at what I started with when we talk about that RMD and the amount. Obviously, the asset total of your retirement accounts are going to determine the amount that you have to take out. So a lot of people, rather than retiring and getting hit with this huge tax bill when they turn 73 because they have all this money that's been growing tax-free in an IRA for a long time, rather than doing that, they start to take steps to mitigate that. So they're reducing the value of that account. And when the market's roaring, that's a tough chore sometimes, but I mean, it's a double-edged sword. So a lot of people will take steps and donate to charities. And so QCDs don't have to come directly from your IRA. I've got two more things. I'm really going to muddy the water when I talk about donor advised funds, but that could be applicable to any one of you guys. So I'll kind of keep that on the back burner here for a minute. But you can participate in qualified charitable distributions before you take your IRA or your RMDs. Sorry, all the acronyms are getting to me. Sorry, guys. So when you turn 70 and a half, you can start to do qualified charitable distributions. And if you're going to give your RMDs to charity anyway, you can mitigate the amount of assets in your IRA by starting early and saying, okay, well, $50,000, I'm gonna donate, obviously under the threshold of 108,000, which will probably be 112,000 or 120, who knows where it's gonna go. But you could take that money at 70 and a half and move that to the charity of your choice. So you don't have to wait till your RMDs. Obviously, when those come around, you can continue to donate. But the QCDs, you only have to be 70 and a half. You can still donate to charities from your IRA as long as you're above 59 and a half. Because anything that comes out of an IRA before 59 and a half, the IRS says, we're going to take 10% of that. Thank you very much. So that is, something to look out for. And, but basically, if I'm 61 and I want to, and charitable giving is of utmost importance to me, then I can start as soon as I turn 60 or 61. I'm just deducting it though. It doesn't work the same as a QCD, which goes right out. It's on your 1099. The IRS knows you're actually filing, and the CPA is going to do it as a deduction. But you can still donate.
I'm sorry, what age did you say you could start doing the QCDs?
70 and a half. 70 and a half. That is, I looked at that. They're probably going to move it on us, of course, but for now, 70 and a half. Yes. But I do have some clients that, once again, are very charitably minded, and they're looking for ways to donate, not necessarily for the tax savings, just because when they leave this planet, they want to be able to say, well, I hope I made a difference, right? And so, once again, your church, whatever organizations, you're wanting to benefit, there's lots of ways to get it done. And if you have any specifics that you'd like to come to me with, I can kind of I can have a CPA just sort of look through it and say, okay, this makes sense, this makes sense. This one's going to get you penalized, whatever it is. But generally, tax avoidance. I mean, this country is a country because we didn't want to pay taxes. And there's some irony in the fact that we're taxed on everything twice over. We're taxed on it and then we go spend it. We're taxed again and again. So I have some clients that are very tax averse, so much so that they've got a portfolio that is doing wonderfully, and they decide that they don't want to give 1 red cent to the government. There are people like this. I don't blame them. If I had a choice, based on some of the news that kind of came out around January about all this money goes into our federal government, we don't know where it goes, and they're not accountable for it, right? I'm sure some of it goes to good things, but some of it does not, I'm assuming, based on what was uncovered. So I have some clients that are so stringent about this that rather than making money in their portfolios that they're taxed on, they have me put the entire portfolio in like U.S. Treasuries, just so they don't have to pay taxes. But that's a big part of what I do. Is lots of time clients need money from, say, a brokerage account. It's invested in the market. So what I do is I go in and cost basis is a very important term, because anything above cost basis is taxable in a particular type of an account. So I'll go in, and the good news is that you don't have to sell all the winners. You can sell some of the losers, because not every stock goes up all the time, and you can offset your gains. So we call that tax loss harvesting, and that's an exercise I go through every year with probably a good 30 clients, where they need some money, it was in the market, and I try to figure out how to make them tax neutral. So if they have $10,000 in capital gains, I try to find, and if the market's doing well, sometimes it's really hard to find, $10,000 in losses that I can sell. And then there's an additional stipulation to that, where if I sell a stock and I buy it back within 30 days, that's called a wash sale. And I am penalized for that by the IRS, which is another way they get you. So if I sell something in someone's taxable account, I will set it, 30 days later, and we'll go back in and buy it again. But you have to watch out for all these little curveballs they like to throw at you. And even when you're trying to be a good person and donate to the charity of your choice, they will still come after you. That's just the way it works. I think we all know that. We've been paying taxes long enough to understand how the IRS functions. But yeah, so I've said a lot. I do want to jump into donor advised funds. That's kind of a niche for particular clients who, like I said, are very philanthropic. They don't need their money. Maybe they don't have kids and the next generations to leave it to, but they want to make sure that they make a difference before they're, passing on to the next life. So when we look at donor advised funds, that's going to be, it primarily deals with the taxable side of the house. But say, for instance, this gentleman who has a ton of Facebook, maybe he doesn't need that money. Maybe he wants to make sure, rather than passing it on to his kids, if he doesn't have any, he wants to make sure that he can make that as tax efficient as possible. So he would create what's called a donor advised fund. And that means that he can move all that Facebook into this donor advised fund. It's kind of like a trust. You're kind of putting it in someone else's hands, whoever the custodian is, who what we'll call, let's see, like Charles Schwab has a donor advised fund. And so they can take that and move it over to the donor advised fund, and it can stay invested. Instead of going directly to the charity, it sits in this fund, and it works like an IRA. So you can take some taxable money that you don't want to be burdened with, move it into a donor advised fund, and it stays in the market, continues to grow like an IRA. It's all tax free, but you've basically said that whatever I put in my donor advised fund, I will never be able to claw that back and use it for my own purposes. I am using that strictly for charity. And you get an immediate deduction on whatever you move over into the donor advised fund. And once again, depending on your situation, if you have to avoid capital gains, that's one way to do it. And then it's also very helpful from an estate planning perspective, because you've moved this money over to the donor advised fund and it's now part of your estate. So what do you do with the estate? You can leave or bequeath wishes for how your assets are going to be allocated once you're gone. And if there's no one around to, serve as a trustee or anything, you've got this donor advised fund and you can dictate, well, I want to give $25,000 a year to my church each year until the money's gone. And so the donor advised fund will do that for you. And you basically get your tax deduction now, and then you kind of have a little more control on when and how you donate to the charities of your choice. Whereas an RMD, that's going to come out and go directly to the charity of your choice. You now, like if you're doing a QCD with your RMD, there we go again, lots of acronyms. But the donor advised fund, you get the immediate benefit, you get that position off your books. So if I was worried about Facebook, I knew I was going to give this money to charity eventually. I wanted to get that out of my portfolio to sort of smooth the ride down a little bit. I'd start a donor advised fund, and then I'd have that money and I could sit there and say, okay, whoever's, managing as a trustee of your donor advised fund will follow your wishes. Even if something happens to you, you know that money's going to keep rolling into the charity of your choice through the donor advised fund.
Can you choose a different charity at certain points? In other words, if you set it up for one charity, can you at some point decide you want to give it to a different charity?
Absolutely.
So it's a
Absolutely.
way of getting rid of your money and still controlling it
Correct.
completely.
Getting it off your books, so you don't have to pay taxes on
Off
it.
your tax books, but you're gonna give that money away when you die.
Correct.
As per your will.
Whereas sometimes when people pass, depending on how they've set up their estate, there could be a will in place, there could be a trust, and those are obviously good things. But a lot of people walk out of their front door and get hit by a bus, and then everything is in shambles and disorder. And who's to say that that money you had intended to give to a charity is actually going to go to a charity? You might have, and I've seen this happen before, where there's a large family and the siblings don't necessarily get along, and there's nothing there to help distribute the assets through the estate, and then your kids have turned on each other for money, and that's where trusts are able to put guardrails around that. Yes, sir.
So, can you use the RMD to fund the DAF?
No, because the benefit, I was speaking from the taxable side.
Yeah. But I didn't know, since the RMD would be taxable,
Mhm.
could you transfer that just directly to a DAF?
You could, but most people use a DAF or donor advised fund because they're sitting on stock that is highly appreciated. That if they pass it on to the next generation, if they have that, the beautiful thing about that is on the day that person passes, that whoever inherits the money gets a step up in cost basis. So if I had Facebook for 10 years, obviously it's had a meteoric rise in its stock valuation. I know I'm not going to use it. This is another route you can take, but you've got a beneficiary who's going to receive that, and whatever it's worth on the day you pass. So it kind of wipes out all the capital gains. But like I said, donor advised funds they're for various purposes. Like I said, everybody has a different unique situation, and that's just one solution. If you want to give to charity and you might have a concentration in a particular stock, whatever it is, I'm using that as the most basic term because that's what I do the most for clients is kind of take those concentrated positions and unwind them for the client in a tax efficient manner. And sometimes putting it in a donor advised fund and knowing that not only are you dictating how that money is going to go to different charities, but if it's invested and there are no tax implications to it once it's in the donor advised fund, like an IRA. So that money, if the market keeps going, and we don't have a crystal ball, but we know historically the market's batting 1,000 for recoveries from any sort of recessive environment. It's never gone down and stayed down. It's always, it's up and to the right, but not in a linear fashion, right? There's dips. But if I put it in the donor advised fund, I know that money will keep growing in the market because it can be invested. It's not just cash. And that way your gift giving can continue for multiple years. As long as the money's there, you can still contribute to whatever your wishes were.
So probably you take taxable funds or from your taxable investment account.
Correct.
Rather than
For donor advised funds,
than your
yes.
IRA. And then, so this would sort of be like saying in your will, I want to give $100,000 to the ABC Foundation. Only you're doing it now, taking the deduction off of your.
Yes, you are enjoying the benefits while you are still alive,
Right.
and this donor advised fund will live on.
And it's gonna go to the ABC Foundation when.
Right. And
Excuse me, Bruce.
Yes, sir.
Thank you. Not to pick up grandkids at 3.
I certainly understand. Stay dry out there. It looks like the rain just started coming down.
Yeah, our thunder's gonna have a dog.
That's what I'm hearing.
All I want to say is that this is a very confusing topic, and there are a lot of rules and regulations around this. So that's why I kind of wanted to start. When I say capital gains, capital gains are something you'll never pay in an IRA. Capital gains are only taxed in taxable accounts. So when you sell something, when you realize a gain, there is a tax implication to that. If the stock's appreciated above what you paid for it, you're going to pay taxes on that. If it's depreciated or it's lower than what you paid for it, you don't owe any taxes. But here's another. You can take the loss. You can take the loss, and the beautiful thing is those losses don't go away. So if one year the market did poorly, and I know that maybe I've got this great investment for next year that I'm sure it's going to make money. So I could sell some losers in 2025 And whatever that amount is, I can deduct $3,000 off my capital gains bill for the next year. And you can keep that going in perpetuity as long as you have the losses, on your tax return, on your 1099.
To apply for
Yeah.
next year.
But a lot of people, once again, are very averse to paying taxes. And what better way you're not benefiting yourself, well, indirectly, because you're not paying taxes to the government. Wouldn't you rather that money go to something you know and trust will go to what it's supposed to go to? And these days, as many charities as there are, I'm sure that there are plenty of nefarious, bad actors out there that take charitable money and it doesn't actually get to the charity. I think we all know that. When we donate to something, you need to do your research. You need to find out exactly how much money is actually being used for what you intend it to be used for, rather than going into the pockets of whoever's running that charity or foundation or whatever it is. So always do your research whenever you're giving to charities. But what I can tell you about Community Presbyterian Church, I see the money go from your account into the church's endowment, and that's it. There's a lot of transparency in what you're doing with your church, but not necessarily with some of these other organizations.
Sorry, we have to go too. We've got dogs that are probably having a nervous breakdown.
I've got one of those too.
Very helpful, thank you.
Thank you
Yes, sir.
very
Thanks for
much.
joining us. And guys, take a card. If you have any questions, I'm here for you. Okay. Do we want to keep expanding the spider web, and let's keep asking questions? Like I said, it's a lot to wrap your head around, especially when I start talking about taxable versus qualified. Qualified being, I try to dumb it down for myself more than anything, and I say retirement and taxable. Those are the two types of accounts, and there are variations of each of those. Like I said, with IRAs, you've got Roth, SEP. But like I said, that if your goal is to mitigate your tax liability when you're retired, obviously you've got this, this RMD looming out in your future, and you know that's going to affect you negatively, especially if you don't need it. There are ways to offset that. Number one, my favorite, is through charitable giving. The second part of that, if charity is important to you, but you've got kids and you want to leave a legacy, everybody's different and they all have different goals. But if you want to leave a legacy for your kids, sure, donating to charity isn't going to benefit them. It's not going to help them buy their first house or whatever it is. But the beautiful thing is you've got Roth. So Roth is another way to mitigate tax liability later in life, because you're willing to shoulder the burden of paying income tax on it now and putting it in a Roth, investing it. Say, for instance, you've got kids and you want to leave them with something, like I said, a legacy. A Roth is the best way to do it, because if you pass away and you leave them your IRA account, basically that passes on to the next generation. What a gift. It's great. They have money to spend, but now they're having to shoulder the taxes, because whatever they take out of that inherited account is part of their adjusted gross income, and it could move them into the next tax bracket. And there are rules around inherited IRAs. The next generation, the government came up with this really neat one. They said, okay, rather than just the standard, RMD, we're gonna put it on the 10-year stretch rule, which is new. That came about with the CARES Act in 2020. So if anybody passes away after 2020, the rules have automatically changed. The government kind of tilted the odds in their favor. They say, okay, rather than taking out a certain amount every year, which is calculated, you have to get it all out in 10 years. And we don't care how much you take out and when you take it out. Just know that in year 10, if it's not zero, you're going to be penalized for that. So that's a new wrinkle.
Well, if you're already over your 70, we're way past that.
Yeah.
And you don't have a Roth, then is it too late to, I mean, kind of,
It's too late to contribute unless you have maybe a part-time job. You know, some people, they retire. I'm using my dad as the example. He retired and I knew it. Like he wasn't just gonna sit around and you know, enjoy his hobbies. Like he just can't sit still. And I knew that he was gonna try to go back and do something part-time. And that's what he's done. So now he's 81 and he's got some income coming in. So he can actually contribute to his Roth. You just have to have earned income. But if you have too much, can't contribute. So, you know, part-time job after retirement, you can contribute to the Roth. However, you can convert. You can
we were
convert when you're
advised not to
100 years
convert
old.
what we had into a Roth.
Yeah.
So, you know, now we're, and I don't wanna go get a job, so.
No. But then they limit how much you can contribute based on how much you make. So I think the max amount is, I think it's changed. It might be $8,000 if you're over 59 and a half. They give you a little breathing room, but basically you could convert IRA assets to Roth whenever you want. Just know you're gonna have to pay the taxes. So anything I convert to Roth, if it's $50,000, if I QCD it, I don't have to pay taxes on it, but then it's not going to my estate, it's going to a charity. But if I convert it to Roth, never too late to do that. Just know that whatever you convert is you're accountable for. You're gonna pay your tax bracket. And it could throw you into the next tax bracket.
Yeah,
That's
yeah, I
where
think
tax
that's where we were
professionals.
advised not to do that because it
Right.
would have really screwed us up. So now what do we do?
Well, I would say,
And we need the income, I mean, we can't just live on.
Yeah.
Yeah, yeah.
well, you know, like I said, everyone's different, but some people, they don't need their RMD, they don't care about it because they might have been one of the lucky ones who ended up with a pension. Those don't even exist anymore, really. But there are several clients I've done financial plans with, and whether it's, you know, a retired soldier, they have a pretty nice pension, pretty good healthcare too. But yeah, it's everyone's situation is different. So I like to sit down and try to figure out, number one, when I meet someone, I want to know what the goal of the portfolio is. I want to know how to allocate it, what strategy to put in there. But number two, I want to get to know them and know what's important to them. Is their church important to them? Is a particular charity that, you know, that the Diabetes Association is very important to me and my family because I have a 15-year-old who was diagnosed with type 1 last year. So we donate to that, and I don't care about the tax savings necessarily. I just hope that whatever money I can give to that organization, they can find a cure. And some people think of it like that. Some people are completely tax minded. That's all they care about. Some people are a mix of the two. And that's my job as the advisor, is to get to know them and figure out what's important and help them get there. And once again, if leaving a legacy to your children is important, I'll explore any way I can to get those money, whatever money, into a Roth for the next generation. Some people, they lean on their RMDs quite a bit. That's how they subsidize their budget. They don't have a great pension that some people have. And they work their entire lives to save this money up. That's what it's there for, subsidize their budget. But some people save it up, don't need it. It's just everybody's different. And that's what I like to do, is get to know people, get to know what their goals are, and act accordingly as the advisor to help them get there through things like Holistic Plan, where we can get sort of a pretty accurate projection of what your tax year is going to look like a year out, and you can make decisions off of that. Okay, well, if they have $150,000 for the next tax bracket and they're willing to pay a little tax but not go into the next tax bracket, let's move 100 over to the Roth conversion. Give them some breathing room, of course, but then once it's in that Roth, we can invest it and it's growing for the next generation. And like I said, who knows what the market's going to give us in the future, but they're batting 1,000 on breaking through to new highs. So there's lots of ways to look at it. I hope this was helpful. But if you need a broader explanation of any of the massive amounts of information I've dumped on you today, call me.
I've got one question.
Yes, sir.
If you convert from a traditional IRA to a Roth, what's the limitations on taking money out of the Roth? Let's just say you
This is a great question.
took every bit of money you had in your IRA, put it in the Roth, I'm gonna pay my tax bill on that full amount. So now that's over here in this pot, and whatever it grows to, or income it produces, or whatever is tax-free, the rest of my life and for 10 years after I die to my beneficiaries. But what happens if I need $100,000 out of there? Is there a limit on taking distributions?
Oh, yeah,
Okay.
of course. The IRS,
Yeah, and
5 years.
5 years, that's what I thought it was.
The
And
5
is
year.
that true even if you already have a Roth established?
This is where
Let's
it
say you've
get,
had a Roth for 20 years,
Uh-huh.
it only has 100 grand in it, and now you put $1 million in there.
Yeah.
So is the 5-year rule waived if you're, no?
it's not. So it's not an exact science, because when you have an investment account, those investments don't stay the same. Different securities appreciate at different rates. So there's a lot of moving parts in a Roth. But a general rule of thumb is, if I have $100,000 in there for 20 years and then I put $1 million in, I would only take $100,000 out for 5 years to be safe. Because if you get audited, that's where the IRS will come in.
You're trying to segregate it. And,
Yes. But that's only if you're audited.
because
Once again, if
earnings
it's,
should always be, you can always take the earnings out.
yeah, and this is never going to be tax advice, but if you had $100,000 and then you put $1 million in and you took $200,000 out, I might be pushing a little bit, but no one's going to really come after you for that. But just know there's a 5-year rule in place.
That's what I'm thinking.
But the growth, if you, and this is where the IRS would look at it, but if it's grown, you've got some leeway on that $100,000, especially if it's been in there 20 years. You can kind of, use your best guess, but it's hard. It's not an exact science because you have all these moving parts. In that 20 years you had a Roth, the investments might have changed 100 times depending on how it's managed. If it's in an S&P 500 ETF and you haven't touched it, that's going to be pretty easy to figure out. But yeah, the 5-year rule.
Well, nobody's gonna get audited anymore because we're not gonna have the IRS agents.
That's,
We can only hope.
Get rid of
they'll have a robot, an AI platform that's like,
Nobody will pay taxes and then there'll be.
at least with an agent, you have a human error. Like, I don't think the way AI is progressing, that might be available.
That's
Like, it might be.
scary.
It is. It really
I'm
is.
thinking about being a waitress, so I don't get charged on my tips.
There you go. And then another president comes in and claws all that back just because out of spite, Like it's amazing the world we live in, guys.
It is.
The last guy was always an idiot.
Exactly. So-
They totally ruined everything.
Yeah, I'm not a political person. I just hope that whoever gets in office will keep the market going up, because I work with a lot of good people, and if the market doesn't do well, I sort of shoulder some of that with my clients. It's a lot of times I equate to what I do to being a therapist more than anything, because a lot of my conversations are talking people off the ledge when the market goes down, and then trying to justify what we're doing if we're not keeping up with the market in a particular quarter. But I always love to have the conversation with clients when the market gets volatile. And as we know, it's very volatile. It will move on a tweet, not even real data, just a tweet. And it'll move rapidly. And so some of these days I have some conversations with clients who are like, help me. The market's crashing. And I always get to look at their portfolio and say, you don't own the
Now's the
market.
time to buy.
Right. You don't own the market, so you're not down near as much as the market. So you got to take that into account. We're building you something customized to your risk tolerance. And if they do have what we'll call a conservative risk tolerance, maybe a short time horizon to where they actually need this money, they're in something a little less, what we'll call volatile or lower beta. Maybe it's a dividend paying company, maybe it's a large cap company, maybe it's not something in the NASDAQ. So generally, I get to have wonderful conversations where, and even in 2022, which the S&P 500 was down 18%, the endowment was down, let me take a look at it real quick. I'll tell you. My computer keeps locking me out. Apologies.
Welcome to Lake City.
6.95%. So we were down a little over a third of what the market was down because of how we've allocated it, because of what this account's being used for. So sometimes it's very client specific. You can't just use these broad terms like the market goes up, whatever. If somebody has a different need, we're gonna accommodate that. But yes, I would encourage you guys, if you have any questions that just sort of pop in your head, shoot me an email. Hey, Bruce, remember when we talked about this? Let me know. This is what I'm planning on doing. Let me know. I can, like I said, bounce it off some CPAs and say, okay, well, do this, this, and this if we want to stay within the lines that the IRS has provided for us. But yeah, thanks for joining, guys.
Thank you.
Thank you.
Thank you, Bruce.
Did you get any fishing? No.
I did. I walked this morning around. I thought I was gonna have more time, but then my phone started going off and client stuff
They
But
were concerned about the tariffs.
yes, absolutely. And there's a lot of commotion around those again. It's kind of like you kick the can down the road with that. Liberation Day obviously provided a lot of adrenaline and anxiety, and the market moved 10% in one day. I haven't seen that since 2001. 2001 was the last time the markets moved 10% in a day. We got that with Liberation Day shortly thereafter, and it's been a wild ride. But then he says, okay, we've had some good conversations. I'm gonna go ahead and move the deadline out. So now we've got August 1st looming, and it's probably gonna be more of the same. But yeah, I did get down to right at North Face Lodge, kind of down there. There are all these nice little riffles. I went down there this morning around 6:30, caught a couple fish, and my phone started calling my name. So I had to
You
go
got a
back.
couple of fish.
Yeah, that's
did.
right.
I'm meeting my wife and daughters in Crested Butte today, later on today. So to kill time, I'm gonna go. Some people suggested down by the bridge there was some really good spots. So I've got all my fishing gear in the car. I'm just gonna
Ready to roll.
Jump
You
down there.
fully charged? You get
I am fully charged.
fully charged? Okay, good deal.
I think I'd say my phone's not charged.
Yeah, I just turned the damn thing off. Well, it's fine. I mean,
And it's-
market's closed, so you know.
It's
Right.
Lake City, cell phones don't always work well here, so,
No, they don't.
And-
Computers either.
yeah, that's true.
but I do, I've been here since 2019 when I started working with the church. I've been here in the dead of winter in February.
That's a
And
challenge.
yeah, it's a challenge.
It's pretty nice. Pretty quiet.
It was very quiet, very cold.
Yeah.
And then once I met with the church, I went over to Crested Butte and
Skis.
I had my skis.
Good.
But I kind of like the summertime a lot more.
You should have gone out fishing on the lake. Build a hole in the
Ice
ice and go out there and join the people out there doing that.
They have TVs, they have the whole
That's
thing.
fine.
I know some buddies that do that, and full disclosure, they don't care if they catch a fish because they're sitting in
I was
that
gonna say-
they're sitting in that with a bunch of beers just stuffed in the snow.
Beer, TV, and heater. I can never have quite figured out how that doesn't eventually fall into the lake.
Exactly.
Amazing
Sometimes
how
it does.
Imagine how you get a fishing pole in a cooler, right?
Exactly.
Collapse.
I've never tried ice fishing. I was when I first moved here, let's just say I took a sabbatical from my job at Xerox. We moved up to Denver, my wife and I, so she could go to law school. And I decided I wanted to be a fly fishing guide, so I would commute from Avon, Colorado, or from Denver to Avon. And I worked for fly fishing outfitters and would take clients out on drift boats and wade fishing trips. And I did that for 3 months, and it was amazing. I always would say it's the best office you can have, standing knee deep in a river with a client. But you, as a guide, you get paid on a tier system. So the more hours you're on the river, the more of the what we'll call the outfitter's fee you get a cut of through Orvis. It was an Orvis program, and I didn't have a lot of hours on the river, so I actually lost money working for that summer because I had to pay for gas going from Denver to Avon whenever I had clients that I was taking out. So yeah, it was a great enriching experience. I got a lot better at fly fishing, but I lost money on the deal, so I had to get a real job in finance.
Orvis didn't lose money on it.
They did not. Orvis did not lose a
Seen those
cent.
fees that they charge.
Oh my gosh, they did not lose a cent.
Thank you so much.
It's my pleasure, guys, and like I said, I'm here as a resource for you guys. Take a card, call me, whatever you need, email me. I think there's a card.
Yeah, we've got one.
That's my cell phone on there, and you've got it. And I'm obviously, whenever I'm in town, hopefully it's when we're actually having service, and I can see you guys at the service, and hopefully we'll do more of these.
Answer, you're on the river.
Yeah.
Thank you.
Selfishly, I do like to take advantage of a trout stream right in front of me. Let's see. Let's do.
I need to give this to Jason.